Good morning and welcome to our WPS Medicare Audit Provider Webinar. This is the 7th in our series of provider audit webinars discussing a variety of audit issues. So our goal for this particular webinar is to cover, again, a variety of miscellaneous audit issues. We'll start off with the S10 uncompensated care audits. Then we'll move over to cost report documentation requirements and the more recent PRA Paperwork Reduction Act package that was just proposed a second time. So we'll talk about that and what the requirements are. We'll go through an overview of current DISH issues. We'll talk about bad debts, the policies, and the new regulations. And then we'll have a couple of audit topics. We'll just briefly go through a few things with nursing and allied health and provider-based physicians. We'll move into a wage index update discussion. That process is coming very shortly. We will give some highlights from the federal fiscal year 2023 IPPS Federal Register Final Rule. And then we'll end with just a discussion of various resources we have here at WPS, including the website, these webinars, and our YouTube channel. So first off, let's talk about the S10 uncompensated care audits. Now, our last webinar earlier this year was focused solely on the S10 uncompensated care audits. But of course, it's an ongoing process throughout the year, so we like to bring up a little bit of a reminder, some updates on this. We are currently in the 3rd year of auditing all DISH-eligible hospitals. It's the 5th year of S10 audits overall, but the first 2 years were just samples, so the 3rd through 5th year, including this year, have been all DISH-eligible hospitals. And by that, we basically mean anybody that has reported DISH. And this brings up a very important point that we'll discuss in the next slide about amended hospitals, amended cost reports. So these next few bullet points are just reminders of the data that is used or is going to be used for the factor 3, which is the hospital-specific factor determining that provider's share of the overall uncompensated care. So the 2021 factor that was in effect 10/1/20 through 9/30/21, this was based on 2017 data. Remember, that wasn't a sample of providers. The next year, 2022, we used 2018 data, and that was the first year that we'd audited 100% of providers. So that's really the first year that has a very high level of assurance for the data, and we have received the final rule for that, of course. That was last year. The 2023 Factor 3, this was proposed and recently finalized, just very recently, earlier this month, that we were going to use averaged data, or CMS was going to use average data. So at first, the average will be 2 years, and that's going to be basically the 18 and 19 that are coming up, that are already available. They're going to be they posted the factors, and then next year, after we get done auditing this year's data, we'll have 2018, 19, and 20 that were all based on 100% of providers, so they should all be reliable. Now this one that one, of course, the 3 years, the 24 factor 3 will come up next year around August. So we're currently auditing data for 2020, as I mentioned. Now, when we talk about these fiscal year 2020 in this case, or any federal fiscal year, we're talking about cost report periods beginning in that year. So beginning from 10/1/19 through 9/30/20, any year that begins that year. Again, our audits are going to be on all acute care hospitals that qualify for DISH. This does include sole community and Medicare-dependent hospitals, even though for sole communities, sometimes they really don't have any benefit from the DISH because their hospital-specific rate was already higher. CMS has currently required, even though there have been a lot of comments on the issue, they do still require that we do an S10 audit on all SCH and MDH hospitals. This year, we decided to send out our request letters in phases, and the large reason for that is that if you take a look at the very end of that cycle, we have, let's just say we had a 9/1/20 through 8/31/21 provider. Now that provider, especially with the various extensions that have gone on this year, still due to COVID, that provider would not have submitted their cost report until after we already started the first round of fiscal years. So for that reason, we decided to give the providers a little bit of extra time after submission to prepare the data. So we sent the letters out in phases, starting with the earlier fiscal years and moving our way forward. And we'll probably do something similar to that next year. The thing about this is all audits are still required to be completed and sent to CMS by December 31st. That was a hard due date last year, and there's no reason to believe it won't be a hard due date this year. Now, here was what I was alluding to earlier, the amended cost reports that are reporting DISH. So if you have an as submitted that did not have DISH, and you all of a sudden submitted amended cost report that did report DISH, this does require us to do an S10 audit. We have a process where we go through we gather some data from our STAR system to look at these amended cost reports, and any of them that have reported DISH and they didn't have DISH initially, so they're not on our initial S10 listing, we have to send out the request letters. Now, the challenge with that is that these are generally still due by December 31st. If one comes in a little bit later, we might have to work with CMS to get a little bit of extra time, but it's certainly not going to be the full amount of time we would normally have for an audit. In other words, the requests are going to be very compressed. We're not going to be able to allow extensions. We're not going to be able to allow a whole lot of extra time to gather the data. We'll need it very quickly. For this reason, it really behooves you to send in any amended cost report as early as possible so that both the auditor and the provider get the full time to do the audit. So these do require S10 audits. There's just no way around it. Now, the S10 lines, again, we've gone through the details of the S10 in several different sessions, including our last session earlier this year, but I just wanted to remind everybody about some of these pieces. So line 20, we're dealing with charity care charges or deductibles coinsurance if it's an insured patient, but it's for the entire facility, at least at this point. And the reason I say that is the PRA package, the Paperwork Reduction Act package, they have proposed some revisions to the cost reporting instructions that may impact these definitions for future years. But for right now, for what we're auditing, this is for the entire facility. Line 22 is partial payments made by patients approved for charity care. Now, there are a few important pieces here to note. This is, first of all, not every payment made by the patient. This is only those payments made by the patient that they weren't liable for anymore. In other words, this amount has already been written off as charity care in a prior year, and now they still came in and decided to pay against that. We're not talking about their payment against their normal liability that was not approved for charity care. That does not belong on line 22. It's only the partial payments made against a previously approved charity care amount. And it has to be, the charity care must have been written off in the prior year, and then the payment is now being made now and accepted now. That's the only time line 22 would come into play. Line 25 is for charges for patient days beyond an indigent care program's length of stay. This is Medicaid or another indigent care program. Now, this one is another oddball that is potentially being changed. We've actually proposed some changes in our public comment to the recent proposed rule for that Paperwork Reduction Act package. But the thing here is, we know that any insured patient is required to be subjected to the cost to charge ratio. Oh, I'm sorry, any non-covered portion of the insured patient's stay. So in other words, the amount that's not really deductible or coinsurance anymore because they weren't covered, instead it's a charge, that's required to be subjected to the cost to charge ratio. Whereas, of course, the deductibles and coinsurance portion are not. Now, for these specific days, Medicaid or indigent care patients beyond the program's length of stay, part of the claim is non-covered and would be a charge. Part of the claim is covered and would be a coinsurance or deductible or copay. The mechanism that CMS put forth for this, it's been around since the beginning, is that those patients specifically will have their entire amount included in line 20, column 2 for insured. Now that amount would include, and we're talking patient liability amount that was approved for charity care, that would include some coinsurance, deductibles, copays, plus some charges for the later portion of the stay. The problem is line 20, column 2 is normally just deductible or coinsurance. The fact that you're including some charges in there requires us to be able to tell the system to subject those charges to the cost to charge ratio. Including those in line 25 as well as line 20, column 2 allows the system to know how much to be subjected to the cost to charge ratio. In the proposed rule, CMS actually went further and they said, hey, let's handle the other exhausted benefit situations, the other part non-covered stays situations in the same manner by having a line 25.01 to include those. Right now, for those other situations, other than the exceeding length of stay limits, they're split. The bill is split. Part of the claim goes in column 1. The charge portion goes in column 1 for the non-covered portion, and the covered portion goes in column 2. So the system already knows how much to subject to the cost to charge ratio. We've actually proposed that CMS, instead of going further into this line 25 and 25.01 mechanism, we've requested or proposed that they go the other way and treat them all as split bill situations where you just have line 20 and your two columns, and part of the claim for any of these non-covered or any of these exhausted benefit situations, including the Medicaid length of stay situation, just split the bill and put the covered portion in column 2 as insured, coinsurance, deductibles, copays, and the non-covered portion in column 1 as a charge. That makes it simpler, and if there's no reason to have that data carved out separately to look at, then why bother with these extra line 25 situations? That's a proposal. It'll be interesting to see what CMS does. Line 26 here. The line is labeled bad debt expense, but that's not true. That's a misnomer. It's actually a bad debt write-off. If you read through the instructions, it's pretty clear that it is a write-off amount. And bad debt expense under GAAP, if the provider uses the allowance method, that's an estimated expense. That's not an actual write-off. The write-off happens later on after a particular patient is known to be non-collectible or there's a much stronger likelihood. The bad debt expense is based on historical data. The write-off is based on patient-specific data. We are required to look at the actual write-off. Furthermore, this is total bad debts. So Medicare and non-Medicare. We're not required to follow Medicare bad debt policies for reporting this number. In fact, we're supposed to be looking at GAAP write-off, generally accepted accounting principles. So in some situations, you might have a Medicare bad debt that, hey, you already wrote that off for GAAP, but it just didn't quite meet the Medicare bad debt requirements yet. Maybe it's still at the collection agency, hasn't been returned. Those rules don't apply to GAAP, but they do apply to Medicare. So what we're saying is there may be a situation where you have a bad debt that's written off under GAAP and should be in line 26, even though it hasn't yet been written off on E Part A, E Part B, or wherever. Now, for those of you that are familiar with the mechanics of the cost reporting instructions on line S10, line 27, 27.01, 28, it brings over Medicare bad debts to carve out of line 26. So it already knows or has an idea what amount of Medicare bad debts are in line 26 already, so that it can do the mechanisms and carve out the 65%, carve out the 65% that was already reimbursed under Medicare, and it only allows the 35% that was not. So there are some issues with the mechanisms there, and CMS has proposed to clean that up in this next PRA package. But the biggest point to make right now is that over a 2-year period, for example, it will be correct. Even if it wasn't written off for Medicare yet, it likely will be in the following year. And over that 2-year period, everything does wash out, everything cleans up. So, a couple of things when we're looking at our information requests. One of the first things we're going to be needing to see is the financial assistance policy. This is important to note because unlike Medicare bad debts, where there are very strict, stringent policies on what is allowed, what must be submitted for documentation, the S10 uncompensated care, the charity care, really CMS's main requirement is that you have something written in your policy and you're following it. There are certain things that are just hard policies that are locked in, that it doesn't matter what your own policy says, CMS overrides it with these couple of requirements. For example, professional fees, physician fees, those are not allowed, period. Courtesy discounts are not allowed. And really those are the two biggest things. For anything else that you want to allow, it must be written into your policy, and then we can review it during the audit. Just a couple of reminders on line 20, the column 1 and column 2. We talked about that a bit. Column 1 is for uninsured patients, and it's also, as we said, it covers any of the non-covered portions of otherwise insured patients for things like regular private pay, regular corporate insurance, Medicaid or indigent care program patients, if as other than the exceeding length of stay situation. Column 2 is for insured patients, but it also includes that non-covered charge related to days exceeding the length of stay limit for the Medicaid patients. So why CMS decided to break that one type of exhausted benefit out, we've never received an answer for. We've asked the question. Seems more reasonable, more proper to treat all exhausted benefits using the same mechanism, and that's what we've proposed. So we said S10, it should exclude any physician or other professional services, any non-patient liabilities. So if the insurance company owes that amount, that's not something that can be written off for charity care. We don't want bad debts there because they're line 26 instead. And we just talked about how courtesy discounts, which are basically for certain groups of individuals that doesn't have anything to do with your financial assistance policy. For example, clergy are often given a courtesy discount, and that's not the same as a charity discount. Courtesy discounts are flat out not allowed. We talked about line 22, and we even talked about line 25. This is the charge portion for the patient days beyond a Medicaid or indigent care programs like the stay, but this amount must also be in line 20, column 2 for the system to work, to calculate it properly. Line 26, we talked about being total bad debt, and again, it's actually write-offs. I'm just using the label there, total bad debt, quote-unquote expense for the entire facility, but we do not want to see any physician or professional services, just like charity care. We also do not want to see any bad debts related to insurance companies or other third parties, which obviously that would be very rare to begin with. We also, the thing here is it's the write-off date that determines what gets reported here. It's not the dates of service. The dates of service might have been a year or two ago. I say they're irrelevant, but if we start seeing things that are 5 years, 6 years, 7 years ago, that obviously increases the risk that maybe this bad debt is not proper. But if it was just the prior year, it might not be that much of a risk. It's probably pretty common. 2 years, 3 years, and beyond would be a little bit riskier. Now, as far as our initial information requests, we're going to be asking for a few different things. These go out with the letters. We need to see the charity charity care policy that was in place for that period, because we need to know what you approve, what you allow in your system, and that way we can take a look and see if you followed your own policy. That's what it boils down to there. We have the next thing, a description of the process used when querying the records. So, and this is really for line 20, line 22, line 26, it's for everything. This is what we refer to as the query logic, which we'll just see in a bit. But notice it's a narrative. We don't actually want to see your programmer's script or anything like that they're using to query the databases. We need to see the actual listing of the charges and payments. We need to see, again, some query logic about how you've identified that professional fees, courtesy discounts, bad debts are not included. That's part of our query logic questionnaire that we'll see later. Any sort of variance that's significant from current to prior year, we'll need to see an explanation of that. Now, obviously, within our COVID periods, since really 2020, midway through 2020, things have changed in the healthcare environment. Some hospitals have seen significant increases, especially when we're talking about 2020 itself. Things have started to somewhat normalize over the years, but 2020 certainly, if you're comparing 19 to 20, and maybe even 20 to 21, there are very likely to be variances, either increases or decreases, depending on the situation, that would be much more significant than what you normally see in a regular year. So this may very well be part of the explanation. We just need to see that. And we want to see a reconciliation of any amounts that are reported on the cost report for those various items to wherever they're going to be found on the working trial balance or financial statements. So bad debts, charity care, we want to see some sort of reconciliation showing how the numbers compare. And then the follow-up information request. So after we start digging into the review, we're going to be looking for a sample. We're going to select a sample from the list, whether it's charity care or bad debt, and we're going to be looking for the supporting documentation for that. Now, if we haven't already received the bad debt listing, that would be as part of the follow-up information request. Hopefully by that time we already received it. And again, we'd have a sample from the bad debt listing as well. The next piece I wanted to mention is that query logic questionnaire. So we have that linked in our website, and again, it's sent out to every provider. It's basically a questionnaire that has about 20 or so questions, a few more than 20, that it serves a few purposes. It serves, first of all, as a training for providers, so you're aware of what we need and how we need it. And while you're putting your data together, it walks you through things to consider. But that's the first purpose it serves. The second purpose it serves, basically it's required by CMS for us as auditors to look at in whatever format we get it, whether it's just a bunch of narratives or whether it's built into this questionnaire. But really this benefits all parties, because one of our first sets of steps is to make sure we have a clean listing without any obvious errors. Because in a proper review, if we found any of those obvious errors up front before we start doing sampling and detailed testing, we'd be able to clean that listing back up. Let's say we found a bunch of professional fees, we would carve those out right off the bat before we start selecting a statistical sample. Now, the goal of being able to get as many of these obvious errors out of the way as possible is that it minimizes the effect of an extrapolated error rate. So the problem is, let's say we did not do any sort of upfront review. We just went straight to a sample and extrapolated everything. The problem is, some of the arguments that we get is, what if there was just one professional fee in that entire listing, one claim that had a professional fee, or maybe just a few. And maybe they were high dollar amounts, but there was just a few of those claims. By the nature of audit, when we do a statistical sample, we would have to extrapolate that, and those dollar errors may lead to a much bigger dollar error on the entire population. Even though statistically and quantitatively it is a defensible review, it's still better just qualitatively, the way you think about it. It's better to get rid of those obvious errors up front, so then there are fewer things to be concerned about with the statistical sampling. And if we did a really clean, or if we did a really strong review up front and we cleaned out a lot of the obvious errors, we might not have any extrapolated errors to begin with. That would be a perfect world. Now, the only way we can do this obvious error check is by having a proper query logic questionnaire, so we know how you built that system, what to look for, how you built that listing, what to look for, and be able to carve those out. Again, the alternative, if we cannot find the errors up front, the only alternative is that those errors will have to be extrapolated through a statistically valid sample. So some information, some resources we have out there specific to S10. We have on our website, the WPS GHA website. These are just a couple of different links here. And actually I have that up. Let me go to that here really quick. Just kind of show you what it looks like on the website. So on our website, when you get to the cost report audit section, if you go down here to the worksheet S10 uncompensated care, you'll see a couple of things. This first one is just a reminder of how everything that you're allowing as part of your charity care policy needs to be written, needs to be included in that policy. But we also have this general worksheet S10 charity care audit link. And here it points to an old Federal Register that really started this review. And then it goes through a lot of the same information I talked about right now, the various lines of the cost report, when the data will be used, how it will be used. And then it points you to various training resources we have, including our YouTube playlist, which obviously has a lot of other topics, not just S10. We'll see that later on. It just gives you a lot of information in a few pages there. So those are the resources we have at this point. And of course, we'll keep bringing it up in these various webinars also. So that is what we had for S10 at this point. Again, we're right in the middle of the process. You've probably talked to your auditor at this point already. But certainly if you have any questions, you can feel free to either type them in the chat area now, or we can talk about them later. The next topic I wanted to talk about was related to cost report documentation requirements. Now, the slideshow I sent out, it still had new cost report documentation requirements, and I kind of removed that because these have really been around for a while. Now they've evolved a little bit, especially with this upcoming PRA package, but the requirement itself has been there for a few years now. I was in the 10-1 or the 2018 Federal Register. So these requirements apply to a variety of different things: medical education, Medicare bad debts, the Medicaid eligible days for DISH, all of our S10, well, I shouldn't say all of the S10, the charity care and uninsured discounts portion of S10, total bad debts. That listing, for some reason, was left out of that initial final rule. So it's not part of the acceptance process. You will not have a cost report rejected if you don't have a total bad debt listing. You still need Medicare bad debts, but you don't need the total bad debt listing at this point. But of course, we need that listing for the S10 audit anyways. Home office costs. This one, fortunately, they changed this. The initial rule was written that every cost report that was submitted that has home office cost needed to have a copy of the home office cost report or cost statement. And obviously that'd be a lot of duplication there, especially for the bigger chains. So they did finalize that, saying that the cost statement where the home office costs are being supported, it just has to be filed with the MAC that services the home office. If you've done that one time, that supports all of your component providers. You're fine there. Now, the requirement here is that whatever amount for any of these items that you've reported on your cost report, those amounts must correspond to the data on your listings. And that correspond to verbiage is exactly what CMS used in their final rule. It doesn't necessarily say tie out exactly. I mean, there's the possibility of rounding issues, which sometimes become a little bit larger depending on the type of listing and how many subtotals you had within that listing. But basically, if you submit a listing that has nothing, is not even close to the amount on your cost report, that would be actually rejected at that point. So that's been around for a while now. This link on our website is to, which I'll bring that up as well, show you where that is, to the cost report documentation templates, the current ones that are out there. What I'll say about that, though, is that they are obviously changing with this final rule. This is essentially the draft version. It's under this cost report link, and we have the cost report documentation requirements and templates. That's where you'll find that information. And again, it just gives you a little excerpt from that Federal Register for each of the topics, gives you the template. The requirement from the Federal Register was not necessarily that you use this exact template. The current requirement that's in place right now before this PRA package is finalized is just that you have to have some listing that supports that amount. The new PRA package that's coming out defines what that listing follow that guideline, the columns in the proper order, reporting what they purport to report. And but again, it seems like it would be a lot easier just to use the template we build. So there is some automation that we will build into it a little bit. Maybe automation is the wrong word. It'll handle your subtotals. It'll give you a summary page, things like that. So we'll switch these listings out once it's finalized. So we have that here. See, we have a question here. During the audit, the auditors always seem to ask for another copy of the home office cost statement. So if that went to a servicing MAC, usually they're supposed to be sending that to us. We're supposed to be able to access that. If we can't access that, and if we were unable to get with that other MAC to get it, I suspect that's why they might have been asking you. So that might be a situation where they just need to uh, keep going to the other MAC, I suppose, and we need to be able to get it. But we obviously need it during the time of audit, one way or the other. We need to get it, so that probably explains why they've been asking for it. We'll just try to get some better contacts at the other MACs to grab the data. So there's always going to be that little bit of disconnect uh, since we're dealing with multiple MACs instead of just our own home office, anything like that. But yeah, good question there. Another question, do we know if there are plans for being able to submit the home office via the MECREF system? Not at this point. I'm not aware of anything. Part of the reason for that, though, is that the home office is still not required. It's not an electronic form the same way that the hospital is. It doesn't have a mandated form set. Uh, I shouldn't say mandated form set. It doesn't have all the specifications for it like the hospital and the SNF do. I imagine that's one of the things that's causing the trouble there. It doesn't go through that same acceptance process. But yeah, I'm not sure if there are any plans in the works for that at this point. Good question though. It would make things a lot easier. Okay, so we have that, and let's go back to this. So these requirements for some sort of listing were effective for cost report periods beginning 10/1/18 and after. And even though we tend to focus on the hospitals for a lot of our discussions, it really impacts all provider types. Of course, some of the listings only matter for hospitals, charity care, your DISH Medicaid eligible days, but bad debts apply to pretty much any facility. Oh, one last thing. There is a YouTube video in our channel that goes through each of these templates and gives you some background for what we're looking for, how they work, all of that. We'll update that as well once the PRA package is finalized and we have new templates. So now on to the change itself. This is the PRA package, or the Paperwork Reduction Act package, that we are talking about here. This is a change that came out fairly recently, June of this year, June 22nd. And we're actually waiting for it for a while, so we thought it would be out sooner. There was the first proposed rule, you may recall. Then there was a pretty big delay. CMS had a lot of comments from that, so they took a while. They published this second proposed rule to see what other comments there are with the revisions. Public comments were due by 7/22. They're proposed to be effective for fiscal years beginning on or after 10/1/22. Now, we're obviously very close to that already, and there's been no word on when the final is going to be published. I would hope sooner rather than later, and I think this will answer another question that just popped up. So the thing about this is that all of this information that they're asking for still would have had to have been in your system somewhere, because it's still valid information we would ask for at the time of audit. The only difference is now it'll be in the listing up front. That'll cut down on future requests for the data. That'll allow us, just like the charity care, to do a cleaner upfront review and eliminate a lot of the sampling and the extrapolation that might be needed, because we can do the obvious error check up front. So that's the only difference. The information, they're not asking for new information that currently doesn't exist somewhere. So for that reason, even if they don't issue this final rule until, let's say, December or February of next year, keep in mind we're talking fiscal year begin. So even if it's halfway through your fiscal year, it's not like all of a sudden you need to go back and create information that you didn't have. It's just that the only difference is when you're filing that cost report, now you need to actually extract that information, whereas you might not have needed to extract it before. You would have still had to have it, but you just didn't extract it for the listing. So that's the difference here. Nonetheless, I suspect that if it's too far after 10/1/22, just because of the pushback, just like that question that you're asking there, I wouldn't be a bit surprised if they update that date if they take too long to finalize it. That's purely speculation, though. It's up to CMS. But I just wanted to give the reason for why they may not necessarily have to. But we did submit quite a few comments to this proposed rule. I imagine other entities, providers, and others have submitted some comments as well. So it'll be interesting to see what comes out of this. Now what I wanted to do is spend a little bit of time walking through the current version of the template, or the proposed version of the template, I guess. I don't want to spend a whole lot of time, but I want to point out some things. And the first thing is, you will actually find this. Let me open up the rule. See where the PRA package is. Let's see, did I close that already? I think it did, darn it. Yeah. Oh, actually, here it is. So I have that link in there, and it takes you to the CMS website, and it's the 255210 form set. So that's what it's listed under. When you open that up, it's going to give you a variety of files. and one of them is the instructions. That's where you're going to find, you'll find all the regulations, all the other stuff here, but the instructions, of course, there are a lot of other changes as well. The S10 changes I mentioned earlier are in here, but you'll also find, for example, your entire set of hospital cost report. Whoops, well, that's weird. Should be there. Hmm. Just there we go. Yeah, I don't know why I didn't find it earlier. It's obviously right there. 3A. It's weird. In any case, you'll see the Exhibit 3A, and you'll find, of course, the instructions themselves. And then after that, you'll find the exhibit. So that document, it has all your exhibits, all these new ones that are listed. But notice the instructions go column by column to tell you what it's for. The labels in some cases are fairly vague. CMS wanted to keep that pretty concise. Some of the things we'd initially proposed, it was a fairly lengthy label, a few more words, and they wanted to cut it down. So for some of these, you have to. Notice they have patient account number and medical record number, as well as Medicaid. Uh, they don't ask for social security number. They've tried to carve that out, things like that. State eligibility code is one that's been questioned recently. And the reason this is needed, some providers and some consulting firms have asked, why is this being proposed? This is required for us to be able to determine whether in your particular state that eligibility code is actually Title 19, true Medicaid, state and federal funding. There were actually some OIG findings in prior years where something that at first glance appeared to be a Medicaid day, it really should not have been, because that's not truly a Title 19 eligibility code. And the requirement is that MACs review that, depending on the scope of the review, of course. There's no way for us to review that unless we know what it is to begin with. So that's the main reason for this code being listed here. Then we have basically information on where in S-2 did you report this, what column. You may recall, if you've dealt with this with Medicaid days before, they break it out into, I think, 5 or 6 columns, different, paid days, non-paid days, out of state, things like that. And that's basically asking, where is this day reported? And then we're talking about the number of days, eligible days, labor and delivery room, newborn baby days. These are basically risk items. We have to look at these a little more. They have different rules, additional rules that must be followed. We want to know the primary and secondary payers. Now, at first glance, this may seem to be unusual. This and this next section is all about the very high risk that a dual eligible patient was included in your Medicaid listing. Dual eligible being Medicaid and Medicare. If it's a dual eligible patient, they're not to be reported as Medicaid days. They're in the SSI ratio, if indeed they also qualified for supplemental security income. So that's what these 5 columns are all about. So hopefully we don't, well, let me take it back. So you might have one claim where they were not Medicare eligible for part of the claim, but then halfway through the claim they became Medicare eligible. So you might have a claim that, yes, it does have Medicare eligibility on here, but only for a portion of the claim. This information would help us to determine how many days truly belong on this listing, and it would have to exclude the Medicare eligibility sections. So that's what this is all about. Of course, there's a comments at the end if you need to explain something about that claim. Charity care listing, we've talked quite a bit about. Again, a lot of that same patient information. Let me see. Now, starting with column 9, uh, this has been pretty much the same with as the current listings, although it's broken into a little more detail now to help clarify it. We start off with the total charges for the claim. And the idea is that we're backing out or carving out certain things that are not charity care so that in the end, when you have the true charity care amount, we can explain how we got there. That's basically what this is all about. So total charges, and by the way, there is an unusual inconsistency with the instructions here with these professional and physician charges. It says something like physician professional charges should not be reported in column 9. But then in column 10, it says, hey, if you reported any of those charges in column 9, carve them out here. So really, we asked CMS to clarify which way do they want it. Do they want them grossed in column 9, aggregated in column 9, and then carved out separately in column 10? Or do they just not want them in the listing, period? Deductible and coinsurance and copay if it's an insured patient. Any third-party payments, insurance companies, whoever, carve those out. Any contractual allowances need to be carved out. Non-covered charges that are not part of your charity care, that's what column 14 is all about. Total patient payments, we're not talking about the line 22 amounts here. We're talking about the entire history of patient payments for this claim, regardless of whether related to charity care, something that was written off or not. It's the total patient and payment amount. Any bad debt portion needs to be carved out. And then what we have here, 17, 18, and 19 is basically what's left that was part of your charity care policy. Uninsured discount, that's allowable. Any non-covered charges that were part of your charity care plan, that goes here. That's different than what's in column 14, though. And then 19 is basically any other charity care that you did not already include in column 17 or 18, but it's still allowable. So 17 through 19 get added up or summed up and reported in 20. And this, by the way, was not coincidence. This was somewhat intentional when we were working with CMS on this. Column 20 is what gets reported on line 20. Obviously, things could change in the final rule, but that was a kind of a happy, not really fully coincidence, but a happy way it worked out there. So column 20 is what you report, and then 21 is the write-off date. At the very end, just making sure that it's in that period. Then we have the S10 total bad debt listing. A lot of similarity between the charity care listing and this. The first slide is all the same. And we're doing the same basic thing here. We're starting with total charges, backing out certain things. Remember, though, these things we're backing out are basically the history of that entire claim, regardless of when each of these payments or adjustments took place. It's the entire history of them. And then now notice we're carving out charity care amounts here. So total charges, we're carving out any of the charity care, regardless of what period it was written off in. So this doesn't necessarily need to match the charity care from your charity care listing. Perhaps it was split across a couple of years. And then, of course, the AR write-off date and the final amount that was written off for bad debt. We propose that CMS flip these around like the charity care so that the date is at the very end. Medicare bad debts, one of the comments that's come up is that we did increase the number of columns for this quite a bit, but it's information that's been needed. Having it up front will allow us to do a review and possibly not have to extrapolate as much, possibly not have to follow up with new information. So we have, first of all, notice MBI or HIC number. Now the reason for that is it's going to depend on when your claim took place and what it was filed under. Was that patient still using a HIC number at that time, or had they converted to the MBI? We need to see what was used, otherwise we're never going to be able to look it up on our system. So that's what we need to have that for. Deemed indigent, this is an indicator that it's not a Medicaid indigent patient, but it's actually a provider deemed indigent. Then, of course, we have the Medicare remittance advice date, Medicaid remittance advice date, and if you had any secondary payer remittance advice date. These are important for the timely billing requirement, which we'll actually see in just a bit. So there's a couple extra columns there, but it actually benefits you as a provider. If that secondary payer RA was well after the Medicare remittance advice, your timely billing requirement doesn't start until that later date. So that'll help you out. Here we're looking at the beneficiary responsibility amount. So what was their responsibility to begin with? When did you first send the bill to them, the date of first bill? Keep in mind that had to be timely. It had to be, the current rule is, or the new rule really, is 120 days from the later of these dates. So that's the new rule. The AR write-off date, again, when was it written off to your accounts receivable? Was it sent to collection agency? And if so, when was it returned? Because keep in mind, bad debts cannot be allowed for Medicare until they've been returned. So that's one of the collection effort cessation dates, if you will. But then you might have other collection efforts that were going on. So we need that cease date there. The Medicare write-off date, which notice if you look at the instructions for column 17, it basically says it cannot be any sooner than the later of these dates. So you can't write it off for Medicare purposes. It's not allowable for Medicare purposes until all of these things have taken place. It had to have been written off on your accounts receivable. It had to have been returned from the collection agency, and any other collection effort must have ceased. So that's what column 17 is all about. These add additional columns to the listing, but again, they make it extremely transparent how you got that Medicare write-off date. This is all information you should have internally. Then we have recoveries. This listing includes both bad debts and recoveries. So if it is a recovery, what amount was received, and do you have what fiscal year was the bad debt written off in? Because if it wasn't written off, there's no need to offset the recovery here. It's the same year payment. Let's see, Medicare deductible amount, Medicare coinsurance, they're required to be split here. Current year payments that have been received, obviously that's not a bad debt if the patient paid it. And where did it come from? Just the source. This is, maybe not as important of a column. I wouldn't be surprised if that gets carved out by the time of the final rule. And then the allowable bad debts. So that's what we have for the listings right now. I see we have a few questions here. Let's see. Medicare Part B days, are they eligible for DISH? Part B only. I'd have to research that. I'm not really sure about the Part B side. I'd have to research that and respond on that one. Do these new requirements apply to cause that are not DISH? Yes, that's a very good question. These requirements, except for the charity care and the total bad debt, these other requirements still apply, like the Medicare bad debts. I guess DISH wouldn't apply. Home office, which is just submitting the home office cost report, those would still apply. Yep. And is there a reason that the different MACs have different sample sizes? So CMS, they don't mandate a sample methodology or a sample size. We tried to have consistent results, and we bring this up in each of our S10. We have a S10 work group with representatives from every MAC in it, and we meet quite frequently. So we bring up topics like this, like S10 sampling, sample sizes. Part of it will depend on what the listing is, but part of it will also depend on what level of scoping they're doing with that. And of course, what methodology they use. There are a variety of sampling methodologies out there, and not every MAC uses the exact same. Now, this applies to other things outside of S10 as well. They might have a system they use for that. We have a system we've built that goes through that. So that's kind of what leads to it. Uh, Keep in mind, though, one of the things, if once these query logic questionnaires are filled out properly, once the listings are cleaned up, then that may significantly cut down on the sample sizes that are even required. It's possible there might be more standardization in the future, but right now CMS has not gone down that path. So, good question there. Let's see. On the bad debt and charity exhibits, how should we handle multiple adjustments on the same account? Should we show each adjustment on its own line or aggregate them? Yeah, I would say aggregate them, where all of those columns are going to basically be the entire history of that claim up to that point. So, I suppose there might be a situation where when we're sampling that one, we'd want to see the history, broken out. But as far as the listing goes, there's no need for that. And in fact, I would go so far as to say if you did that, it actually could cause trouble on the audit side, uh, partly due to the sampling issue, duplicate checks. It would appear like that was a duplicate claim if it was reported multiple times. Obviously, by the time the auditor dug into it, they'd realize it's not duplicate, but it would create some false flags, if you will. So yeah, I'd say aggregate everything. And let's see here. As providers work to be compliant with recent regulations and correct crossover accounts originally written off to Medicaid contractuals, is it acceptable if the contractual is reversed and the new bad debt expense or implicit price concession occurs in a subsequent cost reporting period? So that's the unfortunate. I have an unfortunate response to that. You can't just clean up something that was done improperly to begin with, and that's part of the reason CMS gave that grace period for the Medicaid contractuals. They had that Medicare Learning Network article that basically gave providers a year or two grace period to get their systems in place so that it avoids this issue. Unfortunately, you can't just rewrite it off. You can't fix it and rewrite it off. It's no longer a proper write off at that point. So that's the unfortunate answer to that one. Wish I had a better one for you, but it would no longer be a valid write off at that point. And let's see here. The next topic, which I wish we had some more information on, but we really don't. We have a variety of dish issues that have been pending for several years. It looks like things might be starting to move, but I have absolutely no inside information about that. The only thing we know is the final Supreme Court decision that was issued just very recently, and I just suspect things might start moving. I would imagine they would. I hope they would. But the pending issues that have been out there, one of the big ones is referred to as the Alina Part C Day issue. And the newer one, well, I guess I shouldn't even say newer because it was old and then it's also coming back again. The total versus covered days issue related to exhausted benefits. But the interesting thing, even though these are two separate topics, they both really stem from the same underlying issue. And the question is whether or not that patient was truly entitled to Medicare Part A at that time, or whether they lost entitlement either because they had exhausted coverage or because they gave up Part A and Part B to move over to Part C. And that's really the underlying root issue here. Do they still have entitlement, or is that something you can give up? The reason this matters is that for the Medicare SSI ratio, it's all about whether or not that patient had Medicare entitlement, Medicare Part A entitlement, and they were eligible for Supplemental Security Income, SSI. So if they meet both of those, then they're listed as part of the Medicare SSI ratio, but they obviously cannot also be in the Medicaid ratio. Those two ratios added together become your disproportionate patient payment ratio, or your patient percentage, I should say, which calculates the payment. So you want the days in one ratio or the other, and that's the underlying question: which ratio do they belong in? For some providers, for many providers, having them in the Medicaid ratio might be more helpful, but for some, having a certain day in the Medicare ratio, the SSI ratio, may be more helpful. So that's what these court decisions were all about. Whether or not CMS went through the proper process in proposing and then finalizing their rule, and then whether the underlying rule is proper to begin with. So, go forward to give you the newer information. This was coming from June 24th, and it's it's the Empire Health Foundation Supreme Court decision. The court basically said, well, let's start at the beginning. The question was whether patients entitled to Medicare Part A benefits really give that up just because they have exhausted their benefits or their coverage. The Empire Health Foundation challenged an old 2004 regulation where CMS said these Medicare Part A patients belong in the Medicare SSI ratio, even though they exhausted benefits, and they don't belong in the Medicaid ratio because they'd be dual eligible at that point. So Empire challenged that. CMS was obviously saying they belong in the Medicare SSI ratio. The Supreme Court agreed with CMS and HHS's interpretation. So that's the newest information we have. That's pretty solid information. One question that stems from that is, does this and how does this relate to their Part C issue with Alina? Again, the underlying root cause is the same thing. It's all about, can that entitlement go away? And the Supreme Court basically said, at least for this case, it cannot. At least for exhausted benefits, it cannot. My question would be, why would Part C be any different? That's the same underlying issue, but again, that's up to CMS to determine and to propose a new rule. Back in August 6th of 2020, they issued a proposed rule in response to the original Alina Supreme Court decision. I shouldn't say original. It was one of the later Alina Supreme Court decisions. That court decision basically said, hey, CMS, you need to clarify or clean up your requirements. They went through it the wrong way when they first tried to finalize it, so now they had to fix it up. And this was their attempt to do so. That was back in 2020. Of course, 2020 was a somewhat tumultuous year in general. We have not seen anything else from that yet. But the question is, will we see something now, perhaps to cover both issues? The total versus covered, the exhausted benefits, and the Part C day issue. So that is really the open question here. What's going to come up? Hopefully sooner rather than later. This obviously involves a lot of appeals, a lot of reopenings, a lot of SSI realignment requests that are pending out there. So hopefully we get something at some point soon. I wish I had more information, but really it's been completely quiet on this front. The last we know is the Supreme Court decision. So the next topic here is just bad debts. I've gone through this in previous sessions, so I won't spend a whole lot of time. But back in September of 2020, there was a final rule issued that basically codified a lot of those bad debt policies into regulation. Prior to that, they were just at the policy level, and there were a lot of various appeals on them over the years. The board, the PRRB, is not required to follow CMS policy. They are required to follow the regulation, and CMS codified these into regulation to cut down on the confusion, cut down on the discrepancies, if you will. These changes in policy, or let me back up here. If something was already in policy and now it's just a clarification or a codification of that, then it's going to be retroactively effective because it's always been there. If it's an actual change in policy, so if it's something new that wasn't already listed, then it's going to be prospective for cost reporting periods 10-1 and after, 10-1-20 and after. So we'll go through each one individually. We do have a YouTube video out there detailing each of these changes, similar to what I'm going to say right now. For the collection agency issue, this has always been in policy before or for quite some time that a bad debt is not allowable for Medicare until it's been completely returned from the collection agency, because if it's still out there, arguably collection effort has not ceased, which is an underlying requirement. The other piece that CMS added in as a clarification was that any collection fee that the agency charges you, that cannot offset the bad, or that cannot be part of the bad debt. That cannot offset the recovery, if you will, that you're reporting. Instead, that's a separate cost to be reported on the cost report. So any amount they collect from the patient, the full gross amount, has to be used as a recovery to offset that AR, that accounts receivable. You cannot carve out the collection fee. This is retroactive because it was a clarification. The must bill policy, it's been around, it's been a hot topic since 2004. And the point here is that in order to write off a Medicaid eligible patient, you have to have a Medicaid remittance advice for that dual eligible bad debt. The only thing CMS added here, which actually makes it better for providers, it's a very limited issue. It's where you're in a state where a certain type of provider, healthcare facility, cannot bill. They would never have any obligation to pay. In those cases, the alternative documentation, instead of a Medicaid RA, would be basically information from the plan. There's a state Medicaid notification. Documentation setting forth any state's liability or that they have zero liability. And the big thing is the documentation verifying their eligibility for Medicaid at that point. So this is retroactive because the must bill policy has been in place for, really before 2004, but certainly 2004 and after. Indigents for provider deemed indigent patients. This is the policy at section 312. The policy always said the provider should take into account a patient's total resources, including assets, liabilities, income, and expenses. So 4 things that have always been required. Now, arguably, the word should is controversial there. Should, some argue, imply expenses, because really when we're analyzing risk, these are not the items we're looking at for risk anyways. They're the opposite. But notice that the assets and the revenues, income, they're still required. Of course, the most contentious portion of that is the asset review. And I know there have been a lot of questions over the years about HRSA requirements when you're eligible for the HRSA payments for various things. Apparently, in their requirements, you cannot look for assets. So what we have is two federal agencies at odds with one another. The instructions are contradictory. Unfortunately, for the Medicare program, we're bound to CMS requirements, which is now a regulation. So that's something we've mentioned to CMS over the years, the past couple of years. I don't know if there will be any future changes or if maybe HRSA will change. The only thing I know is what CMS requires. These are prospective. 10/1/20 fiscal year begins and after. Now, the original policy is still in place for all periods prior to that. So in those cases, we would still require liability and expense, even though it doesn't really create any additional risk. Bad debts. So one of the things that's come up over the years is presumptive indigence. And this is basically a situation where you're not really making a separate indigence determination. Instead, you're relying on either like a credit score or just an income amount or maybe eligibility for food stamps or something else. You're presuming that if they're indigent or if they're eligible for those items, that they should also be eligible for indigence. CMS has said that is not allowable. You can use that to start with, but you still have to look at assets, income, liabilities, and expenses. Presumptive indigence is allowable for really for charity care, is what I should have said here on S10. It's allowed for total bad debt, I suppose, but not the Medicare portion of it. A couple of other groups that they're often included under the same indigent umbrella, even though they're technically not the same thing. There are different requirements for them. First of all, deceased beneficiaries. It's not just automatic indigence here. The collection effort that's required is searching for an estate. So you no longer have to necessarily send, I mean, if you know it's a deceased beneficiary, you don't have to keep trying to collect against, obviously, the individual, but you do have to search for an estate to see if there's anybody else that would have been liable for that. The key thing that's come up over the past, I'd say, couple of years is that when CMS does quality reviews of our work, they're looking for tangible and contemporaneous evidence of an estate review, not just some note from a provider representative that, yeah, I searched the estate or searched for the estate. That doesn't really prove anything. We need something, whether it be a print off, a report, a screenshot, an email from somebody in the county. Any of those types of things would work, but they have to be contemporaneous. That's the key thing. When they search, when the provider representative searched, they need to generate some sort of evidence at that point and not just an attestation. Bankrupt patients. So if you have a patient that has declared bankruptcy, again, the collection effort is a little bit different there. You of course have to file a claim with the bankruptcy court, otherwise you're not going to get anything. You'd have to fall in line with all the other creditors. So again, just like the other groups, you must review the financial status at that time. Just because they're bankrupt, even though it seems odd, if you have a bankrupt patient, that doesn't equal automatic indigence determination. It's very likely that they will be after you do the review, just by the nature of bankruptcy, but it's not a guarantee. And let's see, 120-day rules. So interestingly, we now kind of have two 120-day rules. We have the collection effort 120-day rule and the timely billing. Our understanding was that by the policy that might have been allowable. Now it's a very, very high bar. We didn't have very many of them at all, but we thought there could be exceptions made. The Federal Register really strengthened that, and it is now an absolute rule. Uh, you must wait 120 days, and the only exception is the one that's been there all along for indigent patients. They're exempt from collection effort, whether it be provider deemed indigent or dual eligible. And the other thing about that is that they reiterated something that's come up multiple times over the years. Any payment, even a seemingly token $1 payment that is made during that 120-day period, resets that 120-day clock. So they made that statement there because if the patient's paying something, then sound business judgment might determine that, hey, maybe you will still get some money. It might take a long time to get it, but they're not ignoring you. They're giving you something. So this is a clarification. It's not new policy, and therefore it's going to be retroactive. And timely billing, I talked about that. This one was indeed a change, but it's a good change, at least in most cases. So the timely billing rule basically says that the bill must be issued to the patient shortly after death or discharge of the patient. And the Federal Register finally defines shortly after. Prior to that, it was completely up to MACs what they determined shortly after to mean. And different MACs might have had slightly different policies. The new requirement is that it's 120 days after the later of these, the date of the Medicare RA, which previously was the only thing we were concerned with. By the way, if you have multiple Medicare RAs, it's actually the later one that's being used. That's the later one that's going to be reported on the listing. The date of the RA from the secondary payer, if there is one, or if that secondary payer does not cover those services, the later date of that notification, if it's not truly an RA. So the later of these three things, and then add 120 days on top of it, I would venture to say that's much more generous than any MACs policy ever was before. A lot of them were based solely on the Medicare RA. Our policy previously, and by the way, since CMS, the policy before was completely up to MACs, so technically a MAC could change it over time. And I think we did have a change at one point years ago. So now that CMS has defined what they believe timely to be, we have implemented this change immediately because of the fact that it's more beneficial to providers. There's no reason to stick with the older time frame now that we know what CMS was expecting. The old policy basically said if we're scoping it, so we had a threshold for when we would actually start scoping this, and then at that point it was basically 90 days from the date of the Medicare RA or the later, or no, I'm sorry, the date of the Medicare RA. We didn't even we weren't even concerned with any of these other items, so that automatically gives you additional time there. Now we have the issues which actually were related to that question from earlier. The write-off of bad debts and differences between GAAP, generally accepted accounting principles, versus Medicare requirements. The prior rules, CMS policy, required that the write-off, I just say, involve an expense account. And the reason I say that is that the write-off itself under GAAP is not really involving an expense account. The expense already took place when they estimated it up front. Under GAAP, the allowance method for reporting bad debts is required. So you're going to write it off to the allowance for doubtful accounts or the provision for bad debts, whatever account you use, that contra asset account. And then at that point, you're going to have an expense. But later on, after 120 days or so, you're going to find out that patient is actually a bad debt. You're not writing it off to expense again. You already estimated an expense. Now you're just writing it off against the allowance and then the accounts receivable. So that's the difference here. That's why some of the verbiage is a little messy. But now the rules, uh, oh yeah, so they require the later write-off against AR because we're not concerned with what the estimated expense was. We're concerned with the actual write-off against AR. So the change here under the GAAP side, which is, by the way, it's still kind of working its way through. There was a bit of a delay and it actually dealt with COVID. The FASB put it on hold for a while. And they basically said that now, instead of charging this off against an expense account when you first estimated it, now it's going to be charged against a contra revenue account. They call it the implicit price concession. So the idea is on your income statement, instead of having service revenues and then later on you have a bunch of expenses, including bad debt expense to get your net income, now you have service revenues minus any, of course, there'll be other contractual or other contra revenues like contractual allowances, but you'd have all of your revenue offsets right away before you get a net revenue amount. And then you start writing off against whatever other operating expenses you have. So the difference here with bad debt is that it's being removed up higher in the income statement as opposed to waiting until you get to the operating expenses. Of course, it changes the various ratios, financial analysis ratios, and all of that. But the point here is that it's no longer going to involve an expense account at all. It's going to involve a contra revenue. So CMS obviously had to change their policy. They can no longer say you must have an expense account involved because GAAP tells you can't. The problem is it took a little bit longer than expected for CMS to change that. There was a 1-year period before the policy was changed. But in the Federal Register, CMS just clarifies this. The question here is what to do about current periods that are not in line with GAAP. So that 1-year period before that contra revenue is allowed. We brought this up to CMS because those providers that had to adopt the GAAP standard early are in a hard place. There's absolutely no way to meet both requirements. And by its nature, Medicare policies, they try to follow GAAP because you're required to follow GAAP to begin with. So we've asked CMS this, and the response is basically for this issue, it's up to Max, how they scope this particular issue, and we can use our discretion for this 1-year period. So that's kind of the answer we were given. So essentially, don't worry about this 1-year period where if you had to adopt the GAAP standard and you had to start writing off against a contra revenue, the implicit price concession, then that's fine. And then the Medicare regulation kicks into play the next year and everybody will be on contra revenue. Now, the point I want to make here is this next topic is a little bit different. I brought up contractual allowances, and they are indeed another type of contra revenue account. They offset the revenue directly, but for a different reason. And it's an important reason that CMS felt it was important to remind providers about this. If you have a true contractual allowance, then technically or legally, that's not an amount you're legally even entitled to. You've waived the ability to collect against that amount, whether it be to an insurance requirement, which is usually what it is, or whatever. So if you're calling something a contractual allowance, if you've written it off against that contractual allowance, it cannot be written off as a Medicare bad debt. It should have either been charged against the expense or now the other contra revenue account, the implicit price concession. This is that Medicare Learning Network article I referenced earlier from 2019. CMS reminded providers of this. It's always been in place. It's just they started seeing more findings where this was being allowed and it shouldn't have. So they had a quality of finding against the contract or the MAC. So to fix this, they gave a grace period up to the last cost reporting periods beginning before 10/1/19. So I guess It wasn't a full year there, but they gave a grace period for providers to get their systems changed so that everything would be properly written off. If it was not really a contractual allowance, then don't write it off as such. It needed to be written off against an expense, or at least include an expense for the estimate and then written off against the allowance account later on. That grace period is now expired, and this is something CMS does review from time to time, and it goes back to that question that was asked earlier. If it was written off against a contractual allowance, then that write-off was invalid, and we cannot allow it after this period. Now it's codified into the rule, into regulation, effective for 10/1/20 fiscal year begins and after. So there's yet another GAAP period, GAP period of 1 year, where this requirement is just at the policy level. Between 10/1/19 and 10/1/20, the policy is still in place, but it's at the policy level instead of the regulation. So that's the difference there. It's stronger 10/1/20, but we still have to abide by it 10/1/19 and after. So those are the bad debt requirements. And let's see, let's catch up on the questions here. So if we have an account that has a charity write-off in 2 different cost report periods, and we report the account in the aggregate and not by individual write-off date, wouldn't we be duplicating write-offs in multiple years? So for the charity care listing, that amount you're reporting in the final charity care column, that's just going to be the charity care written off during that period. Now, I see where your question is coming from, and I should have clarified this earlier. When we're starting with total charges and carving things out, we're not always going to get exactly down to that charity care amount, because there might be a situation where the patient is still owing something or it's unresolved and it just hasn't been reported anywhere yet. It's not a contractual allowance, it's not a payment, it's not yet a charity care, it's not a bad debt. So that amount might not be there, period. So if you take all those components, all those other columns that come after total charges, the rule is basically that if you add those components up, it can never exceed total charges. It can certainly be less than total charges if that patient just hasn't made their full payment yet, or if you haven't yet decided to write that off as charity care. And then in the second year, the same situation may happen because, well, actually by that year, the same situation would happen because now you're writing off the other piece of charity care, and the first piece would no longer be on that listing because the charity care listing does not have a lifetime history of charity care. It's only charity care for that 1 year. So the same issue or the flip side of that issue would happen in year 2. Good question there, though. And for the Medicaid contractual, yeah, unfortunately, that's one of those topics that's come up, and there's just anything you would try to do to correct it would result in an improper bad debt write-off. So when this has come up with CMS, it's basically just not allowable. It's a permanently tainted bad debt at that point, and that's the unfortunate part. Because you could argue otherwise. I mean, if CMS were to allow that, then what's the point of having a rule, period? Down the road, 10 years down the road, providers could all of a sudden do something accounting-wise, rebook it, and fix it. That would seem to defeat the purpose of ever having any rule in place, period. So, yeah, it's just, there are a few things when it comes to policy, Medicare bad debt policy, that can taint a bad debt permanently, and that's one of them. The other one, for example, would be your timely billing. If you waited a year after the secondary payer RA to bill it, there's nothing you can do about that. There's no fixing it. You just waited way too long. The bad debt is now tainted. So that's it's kind of an unfortunate piece there. And let's see. Yeah, so we will I do have a piece on DISH Medicaid eligible Section 1115 waiver days. That comes up in the actual final rule topic here in just a little bit. So we'll see that coverage. The next topic that I wanted to briefly cover is the nursing and allied health. Nothing really new here, but it is still a hot topic, so I wanted to bring it up. CMS continues to have MACs review the legal operator requirements for nursing and allied health. Basically, they want to make sure if you're reporting that as a provider operated program, that it meets all the requirements. Because if you report it as a non-provider operated program, you're not going to be getting the same types of costs. You're not going to be getting both the clinical and classroom training costs that you would if it's a provider operated cost. And there's also a cap that comes into play for non-provider operated. So if you have a program that you believe you're the legal operator of, the requirements are that you have to directly incur the training costs, directly control, you have to have direct control over the program curriculum, you have to control the administration of the program, employ the teaching staff, and provide both the classroom and clinical training. And then number 6, it's at the very end if you read this regulation, and there's some unfortunate verbiage, some very confusing verbiage, the way it's written. But basically this degree or diploma is just one more of the criteria that have to be met. And that's what CMS clarified in this change request 10552 back in 2018. They basically said, hey, you cannot just look at the degree or diploma and completely ignore the first criteria. Even though the regulation seems to have some confusing verbiage that would imply that's the case, CMS clarified it and said that's not at all what was intended. So just a reminder about these. We do have a website that goes through these in more detail, as well as a YouTube video that's linked into this website that talks through, what is directly incurring the cost, what is controlling the administration, all of that. I think that one's about an hour-long video, if I remember right, going through that. The next one we have a few slides on is the provider-based physicians, and specifically the time studies and the allocation agreements. So the regulations require that if you have provider-based physicians on A82, worksheet A82, you're going to be reporting some of these costs as physician component, potentially some of these costs as provider component. By the way, the physician component is considered the Part B. It's the non-allowable portion. Provider component is Part A. It is allowable, assuming you meet all the requirements. So the rule says in the absence of a written allocation agreement, 100% of your costs are considered to be physician component, which basically means they're not allowable. So the penalty for not including an allocation agreement is that you do not get any reimbursement for them. Now, there are 2 exceptions. One of them is kind of an interesting exception because if it's 100% physician component already, then there's really no consequence to having an allocation agreement anyways, because you're already where you would be after that penalty. The other one, though, is interesting. If it's 100% provider component, which seems very risky, but if there's evidence of no reassigned billing rights, in other words, the physician maintains their own billing of the Part B stuff, if that's the case, then there's no reason to split it, because the only cost coming through the hospital would indeed be provider component items. They're not reporting anything for the Part B side because the physician is doing that themselves. Of course, you have to prove this part. You have to prove that there's evidence of no reassigned billing, a contract or some statement from the physician that they bill for their own Part B portions. The requirement here, that's, again, a lot of these things we bring up in training are because we've had findings from CMS. That's what leads to a lot of these hot topics. But when we're looking at these allocation agreements, the goal is that this was agreed upon at that time whenever that form was prepared. In other words, whenever whenever they agree to that split. So a contemporaneous signature is required by the physician or department head that, yes, they spent 75% of their time in physician component, 25% of their time in provider component, or whatever. Now, so that's one of the main requirements just for that allocation agreement. It's a time allocation agreement, by the way, not necessarily a dollar allocation, although the time should lead to the dollar allocation, but the agreement itself is for time. The time studies support the allocation agreements, assuming you don't have some sort of system that gives you ongoing time reports. Some providers do, and obviously that would be the highest level of evidence. But if you do a time study, then here's the key thing. We're talking about physicians here. They're not subject to the same very stringent time study requirements of Section 2313.2. Like if you have an organ acquisition program, you have to follow those stringent time studies, and really any other non-physician has to follow those more stringent requirements. But this section right here basically gives physicians an out. They can certainly use those stringent ones, but the provider may not be required by the MAC to utilize that specific methodology. So as an alternative, the standard that's been in place for most MACs that I'm aware of is just 2 weeks per quarter. Instead of 1 week per month with very specific requirements, it's just 2 weeks per quarter without those other specific requirements. There's no pre-approval required, but you can certainly send it in if you want us to look at it. There's just not much to look at. That's the thing. We don't have to figure out, did you use the first week here and then try to use the first week the next time again? That's not an issue for physician time studies. But again, this is something CMS for a while was hitting pretty hard. There must be contemporaneous signatures. And what that means is you can't expect a physician to come back at the very end of the year and have a really good recall of what they did for those certain weeks within the year, a year ago, potentially. It's unrealistic. I could not tell you the second week of January exactly what I spent my time on. It's just not a reasonable recall. So when they're filling out that time study, within a very reasonable time after that, it doesn't have to necessarily be the last day of that week, but it should be very soon after. We need to have the signature at that point, or some sort of doesn't have to be a written signature anymore. It could be an email saying, yes, I filled out the time study into the system. Just something proving that this was done at that time. Some other issues that have come up with physician time studies, the whole idea of on-call versus availability. On-call is basically off-site, and then they're required to come to the facility to provide service quickly. Availability, they're still on site. The rules currently, at least, are different for when each of those can be triggered, but they're both only allowed in the emergency room. If you look at the policy and regulations for both, it's specific to the emergency room. Here's just a link to a YouTube video we have on provider-based physicians. This one's a fairly recent one. And the next couple of slides, I just have a screenshot and references to the actual policy. The on-call provisions are found in the claims processing manual. It's not the same place where you'll find the availability provisions. It only came into place in 2005. It's only for a critical access hospital, and it gives you the list of certain professionals that this covers. So doctor of medicine, physician assistant, nurse practitioner. So it gives you a pretty good list there. The availability requirements are actually under the regulation. Well, they start the regulation at 415.55. It talks about except for reasonable availability of services. So it says it does not include physician availability services except for reasonable availability for ER rooms. That's what we're talking about here. Notice that this is not just the critical access hospital. and then the actual regulation at 2109.3, PRM1, 2109.3, the policy, I'm sorry, it goes into more detail on what is required to allow that availability cost. One of the key things that's come up in recent years, there must be a demonstration that the provider explored alternative methods for obtaining physician coverage. They give some detail on that. Again, you're going to have supporting data for it, the time studies, all of that. So that's what we have for the provider-based physician. Let me catch up on the questions here. Let's see. As far as an increase in appeals for providers, yeah, I mean, there have been some. I don't know if I'd say an increase necessarily. We've certainly been doing more detailed audits on them since that CMS finding was issued, but maybe not as many appeals as I kind of suspected there would be. I haven't really seen any noticeable increase myself. And let's see, if the physician records contemporaneously but only turns in time quarterly for reimbursement, will that clear the contemporaneous requirement? So I guess the key thing there is we'd have to have proof that they really did that timely. If they, I suppose, for example, if they, I don't know if they sent themselves an email with that or if they have some way of date stamping whatever document they filled out on their own, then that would be fine. But if the physician just comes back and says, "Oh yeah, I jotted some stuff down on paper. It's undated, but I jotted it down and I use that as the source." That's just not auditable evidence. That's the problem with it. How do we know that's accurate? So they'd have to have something showing that they initialized or initiated the recording contemporaneously, and that's certainly fine if they only turn it in later on if they can prove that they filled it out timely. So that's the thing there. Let's see. If it's adjusted off due to being written off as a contractual, but it was reclassed to bad debt on the income statement in the same year. Yeah, if it's the same year, let's see here, because ultimately we're looking for. I mean, yeah, that year that's when it was written off. A lot of the things we're pulling from are was it written off in this cost reporting period. So I think that would be fine. It's an adjusting entry or a correcting entry during that year before closing. That should be fine. We shouldn't have any problem with that. It's when things happen after. So the true write off occurred. Let's just say 2020. The even though it was invalid, that's when the true transaction should have taken place. But then something tries to correct it in 2022. That's where the problem comes in because it's no longer in the right period of write off. It's no longer a correct write off. You're just fixing the records. So in your same year situation, that would be fine. And does the emergency on call also apply to general surgeons on call? So if they're in the are they'd have to be ER surgeons. That's the thing with that. That's only for the emergency. Oh, but they're on emergency call. I mean, I guess just looking at that sentence that you're listing there, if they are truly on call for the emergency room, then yeah, I don't see where there'd be any issue with that. The general surgeons. Let's see, we have if it's true that the physician Part A contract states a minimum number of hours per month, that a time study is not necessary. So you're talking about the minimum guarantee arrangement there. So there, I wish I would have listed that up. There is some information that does exempt that situation from a time study. Uh, Now, if there's that, yeah, there's. I don't have it up with me right now, but in the cost reporting instructions. In fact, let me see. Maybe I can find it quickly here. I believe it was in A82. Let's see here. Oh shoot, maybe it was in the actual detailed policy. Let's see here. Policy manual. Well, you know what? It'll probably be right here. Let me open that up really quick. Hopefully, I should be able to find that little verbiage. I just had it up actually just a couple of weeks ago, I believe. We were having a discussion on that very issue. Let's see, where's the. Oh, there you go. Whoa, some typos there. Let's see. Somewhere. Yeah, I might have to look a little further in there. Somewhere it did say that the time study, they were exempt from the time study for that particular situation. So I'll when I send the email out, I'll respond to that question. I'll include the verbiage that I was talking about there. And yeah, if they date, so Lisa, back to, I think that was your early. Did you have the earlier question? Yeah, if they date stamp it, so if they have proof that yeah they completed their document here on this date, and you do a screenshot. PowerPoint. And now, really, I just have a few slides, really informational more than anything about the wage index. So I'm going to run through these somewhat quickly, but these are the time frames. 9/2 of 22 coming up just a few days, a week or so. That's the revision due date. If you have any revisions from your submitted S3 wage data or occupational mix, we have to receive it by that date because that's essentially when our wage index process starts. And as you can see down here, 11/15 is when everything is due. So we're talking about 600 providers, at least for us, and we have a very, very short period of time to do it. So, CMS set this due date. We cannot go past that. We have to get started on these. It's a fast and furious to get through those by that point. And some more due dates, kind of the timeline. CMS does some data, even though they're submitted in November. CMS does some data analysis, they revise things, and by January 30th, that's when they release the wage index data for review as a draft, if you will, the public use file. And if you see something that's wrong by that point, you have until February 15th to submit requests for corrections. By March 20th, we have to transmit the final revised data. So there's not a whole lot of time for that kind of second round, if you will. Hopefully that should be somewhat minimal, but we have a little bit of time there. And then 4/3, April 3rd is the deadline for any wage index appeals. There's some new information here on how you need to submit be in PDF or Word as opposed to maybe an image file, and spreadsheets should be in Excel. Here's an alternative. If you're not able to submit it for this first year, they give you an email address to use as they're phasing the system in. April 3rd, if you want to dispute any data corrections that CMS made based on that last review, that's the due date for that. And then somewhere, usually late April or May, they have the proposed rule, which the IPPS proposed rule, which includes the wage index information. Now here we have on our website, we have a variety of different things related to wage index for resources, and I wanted to show you a couple of those here. Oh, here it is. So we go back to the cost report audit section. You'll see at the close to the end, we have two different things. The main one I'm talking about right now is the hospital wage index link. It's the bottom one under that wage index section. So if you go there, it gives you some overview, but this guidance document, this is our goal is to give you some training there, if you will, on that, or an informational resource, really. So if you open that one up, that over here, you'll see a variety of things. We have a lot of FAQs, the occupational mix, as well as just a reminder checklist for certain things to consider when you're putting together your information. Now, this is somewhat of a living document, so we'll be updating this. We try to update it after we learn new things from each year's process. Gives you a summary of notes about each of the different S-3 parts. So some of these are cost reporting instructions. Some of them are just WPS notes. We usually have those highlighted. So the idea is to give you any sort of resource we have, and we expect that this will continue to expand over the years. Let's see here. Back to the slides. And this is just a follow-up for that wage index reminder checklist. Here, one note, if you're making adjustments to wage index, we certainly encourage you, we would love if you submit the HFS auditor file, the .auditor file. That allows us to see the explicit adjustments you made, what lines you made them to. It's a lot easier than having to comb through the cost report to figure out what was different. At this point, for hospitals, I believe HFS is the only vendor that's left. They've been that way for the past couple of years. So this really doesn't apply anymore. And looks like we have a couple of questions for wage index. It seems like the MACs have been digging into physician Part A and Part B time report on S-3 Part 2. So this is actually something, these are all based on CMS's requirements each year. Occasionally they do change. They focus on certain things. They tell us to gear our reviews towards something else. So we have a checklist or a UDR, not a UDR, a desk review, wage index desk review that we are required to follow from CMS, and they issue it every year. There's any plan to build one quickly, so I can get back to you on that one in our email as well. Good question though. Thank you. And yeah, right now for MECRF is only currently allowed for an as submitted or amended cost report. It cannot be used for wage index or S10 or even reopenings. It can't be used for that. When CMS built that, they really had that sole purpose in mind. Now we have our file exchange, our secure EDI portal that we use. It's a good way of sending stuff in. Other Macs may have some similar portals. I don't know if CMS will ever be expanding MECRF for other things. I know that certainly was not the initial purpose of it, but it's something we can talk about there or bring up. Okay, so let's get into the final rule here. Just a brief discussion on that. And we have just some information on the DISH uncompensated care. I know we're down to about 10 minutes left. The amount they're submitting, or the amount they finalized that is being paid out to all providers, is $6.8 billion spread out based on each provider's UCP factor 3. That's why the S10 is so important. It determines your share of that $6.8 million or billion dollars. We already said in S10 that right now CMS has finalized they're going to be using a 2-year average of 2018 and 2019 data. That's going to be the upcoming 2023 factor 3. So that's, in other words, that's the one that's coming up effective 10/1/22. And the next year they're going to average 2018, 19, and 20. They just didn't feel confident with the 2017 data. Obviously, it wasn't audited under the same protocols or anything. So they're going to average starting with 2018. Now, one thing, if you were to read that Federal Register, there's a brief reference to, amendments or reopenings. The thing to remember, though, is that reopenings are actually only accepted when there's a reopening materiality, and that's a settlement impact. So, in other words, S10 is generally not something you'd see in a reopening environment. There's no current year settlement impact, and that's one of the things CMS looks at when they quality review our reopenings, is did we follow our own materiality impact when determining whether to reopen that cost report. So that's just a note I wanted to make there. One thing, a question was asked earlier about the DISH or the Medicaid days, Section 1115 waiver days. There was a proposal in the proposed rule for this year to explicitly disallow these certain groups of Section 1115 waiver days that weren't really paid, weren't really covered. And what CMS is saying now is that they're currently dropping that proposal. So those same Section 1115 waiver days currently are still allowable until they change the rule down the road. So that's one thing to keep in mind there. Of course, you have to have the documentation for it to show that. And another important thing I want to point out, because we've started to receive a lot of the low volume requests, under current legislation, both low volume and MDH expire in a little over a month unless Congress extends them through additional legislation. Now, they've done that over time, multiple years. I mean, MDH was supposed to expire way back in 94, and it never did. Well, I shouldn't say it never did. It did temporarily a couple times. Low volume was never intended to last this long. The low volume changes, I should say, the revised low volume, the enhanced low volume, that's been expired all the way since 2011. Only Congress knows, or I guess they don't know yet, whether that's going to be passed. I kind of suspect it will be, but CMS absolutely has to require or has to abide by what the legislation says. So the only thing they could possibly do in this final rule was what is currently in legislation, regardless of any proposals that are out there or draft bills or anything like that. So right now, as it stands, nothing is moving forward with low volume and MDH. Well, low volume specifically. We've received a lot of low volume requests, and we are just saving them right now to see if Congress does extend this. If they do extend it, CMS will be issuing another rule giving us the due date. The last time this happened where it lapsed, they gave an extra month to submit that written attestation. Or who knows, maybe they'll do away with the written attestation altogether. We've actually proposed that in the past. So more to come, but right now, I don't know anything. You can certainly submit the request and I'll save it. That just gets it off of your list. And then if they extend it, we're good to go. We'll review it and go with that. For MDH, what they said in the proposed rule is that if you're an MDH that would also qualify as an SCH, I mean, I guess at that point, I don't know why you would not have already gone the SCH route because it's more beneficial. You get the full hospital specific rate. But if you're in that situation, you can start submitting your request for SCH status, basically converting from MDH to SCH. That would behoove you to do that anyways, really. And then the last, oh, yeah, I see a question there. So yeah, the low volume requests right now, they are not due, period. There's no low volume review underway. So there is no due date. Uh, it's usually 9/1 of every year, but again, there's nothing. The wheels are not moving whatsoever at this point. So no due date. If it does get extended, there will be a new due date posted at some point. And the last few slides I have here are just reminders of our website, webinars, YouTube channel, basically all the resources we have out there. Our goal is to have this as an educational resource for both the providers and even for our internal auditors or our auditors. And the idea here is that if we have something where we've addressed CMS policy or a regulation, we write it out in a narrative, we have it in more of a training format, an article format, and the goal is that if an auditor is having a discussion with you on that topic, they have something to refer you to give you a standard definition or standard explanation. So we try to continually enhance this and update the articles that need updating, add new articles on new topics. So that's why I try to refer to that quite a bit. A lot of times over the past couple of years, when we've had a bigger topic on the website, we also try to pair it with a YouTube video, really showing some examples or just putting a voice to a written narrative, if you will. We're not reading it per se. We generally have some slides that we go off of just to further describe what you read in that one-page narrative. So that's the idea there. Some of them are quick 15, 20-minute videos. Some of them go all the way to an hour. That was not my intent initially, but some of those topics you just really need to go into that much detail on for it to be worth anything. What I have here, and I'll do this probably for the next couple of webinars, but at some point we'll cut it off because the list will just be too darn long. But this next few slides just gives a listing of the YouTube videos we have out there. And I'm not going to read through them all. You'll see we started in September of 2019. It gives you the time. So 60 minutes, 40 minutes, all of that. It gives you the YouTube link and it tells you what it's for. The one thing I will point out is we actually have some got moved to the last slide. EHR payment reductions. There have been a lot of questions on that over the years. So this July we posted one there. In August, or I guess, oh no, I'm sorry, that was last year. We posted the EHR payment reductions, provider-based physicians, audit sampling. Gosh, that doesn't seem like a year ago. Wow. But audit sampling, posted that one out there. All of our webinars are recorded. By the way, this one I just noticed, the recording got started a little bit into it when we were starting to talk about some of the charity care. So my apologies. I think the first 10 minutes might be cut off, but the rest of it's recorded. We'll post that out there and on our website. Cost assignment and allocation. ESRD high discharges for those few patient or providers that qualify for it. SCH MDH volume decrease. That one was earlier this year. Again, relatively rare. And we'll be posting additional ones out there as new topics come up and as time permits, essentially. And this was just the webinars. Obviously, I guess it ended up being late August, but that's our scheduled one. The next one will be approximately 3 months. Around 3 months, 3.5 from now, we'll post another one. We'll hopefully have some more information on things like the dish, maybe some of these issues from the final rule, things like that. And that takes us right to about a minute before 11 o'clock. So thanks for your time. Any final questions here before we wrap up? And if nothing else, even if I can't answer it now, I can post a response in our email as well. Sounds good. Well, thank you.